Over the past few months, the value of the US dollar has been steadily increasing as financial markets anticipated that Trump's economic policies would have significant effects on global economies and lead to multiple interest rate hikes from the Federal Reserve. However, after experiencing a gradual and mild decline throughout February, the dollar has suddenly taken a sharp downturn in recent days, reaching its lowest level of the year. In this discussion, we will explore the reasons behind this sudden drop in the dollar's value and examine its implications for both the U.S. economy and the global financial landscape. To fully understand this situation, it's essential to consider some background context. When it became apparent in late 2024 that Trump had a strong chance of winning the presidential election, and even more so after he officially won, the dollar experienced a rapid surge against other global currencies. One of the best ways to measure this trend is through the dollar index, which tracks the strength of the US dollar relative to a weighted basket of international currencies. Unlike direct comparisons between the dollar and individual currencies, such as the euro or the British pound, which only provide insight into the value of those specific currencies, the dollar index offers a more comprehensive view of the dollar's overall strength in the global market. According to this index, the dollar steadily appreciated from late September, reaching a peak in early January, its highest level in nearly 3 years. In fact, this increase in value may even understate how strong the dollar had become. If we exclude the brief surge that occurred at the start of the COVID-19 pandemic, when investors flocked to the dollar as a safe haven asset in times of uncertainty, this January peak marked the strongest the dollar had been since 2002. So, what caused the prospect of Trump's re-election to drive such a significant surge in the dollar's value? There were essentially 3 main factors contributing to this trend. Firstly, investors believed that Trump's economic policies, including tax cuts and tariffs, would lead to higher inflation. In turn, this inflationary pressure was expected to prompt the Federal Reserve to implement more aggressive interest rate hikes. Higher interest rates tend to make the dollar more attractive to investors, as they offer better returns on savings and U.S.-denominated assets. Secondly, there was a widespread perception that Trump's trade policies, particularly his aggressive stance on tariffs and trade wars, would have a more detrimental impact on other economies than on the United States. If foreign economies struggled more than the U.S., their respective currencies would become less attractive to investors, which would, by contrast, boost the relative strength of the dollar. Since the value of the U.S. dollar is measured in comparison to other currencies, any weakening of those currencies naturally results in the dollar appearing stronger. Lastly, there was a strong sense of optimism within the American business community that Trump's proposed agenda, centered around tax cuts and deregulation, would stimulate economic growth. This optimism was further reinforced by the prevailing belief that rapid advancements in artificial intelligence, AI, would bolster economic expansion in the near future, further strengthening the U.S. dollar. However, despite this initial surge in value, the dollar's trajectory has sharply reversed over the past few weeks. Although February saw a gradual decline, the past few days have witnessed a much more dramatic drop, which could reasonably be described as a crash. As of Thursday morning, the dollar had fallen to its lowest level since the November election. While it may seem dramatic to refer to this downturn as a crash, it is important to note that the dollar remains relatively strong by historical standards. What makes this decline particularly noteworthy, however, is the speed at which it has occurred. This is the most rapid decline the dollar has experienced since the onset of the COVID-19 pandemic. Moreover, this downturn is occurring at the same time that Trump is implementing substantial tariffs on major trade partners like China, Mexico, and Canada. Measures that, based on previous patterns, should have bolstered the dollar rather than weakened it. So what is causing this unexpected decline? As is often the case with financial markets, it is difficult to pinpoint a single definitive reason. However, there are several plausible explanations. One possibility is that Trump's tariff policies have been more targeted and selective than investors originally anticipated. Unlike the broad, sweeping tariffs he had promised during his campaign, the actual measures enacted have been more narrowly focused. Another potential factor is that recent technological advancements by Chinese companies such as DeepSeek and European firms like Mistel have challenged the assumption that the U.S. would be the primary beneficiary of AI-driven economic growth. However, the most widely accepted explanation is that Trump's policies are not actually stimulating economic growth as intended, but are instead pushing the U.S. toward a potential recession. We recently released an in-depth analysis on this topic, which you can watch for more details. But in summary, the key issue is the high level of uncertainty surrounding Trump's economic strategy. His frequent policy reversals, especially regarding trade and tariffs, have created an environment of instability that has dampened both consumer and business confidence. As a result, the U.S. economy now appears to be at risk of entering a recession. This level of uncertainty is not just a perception, it is measurable. The Federal Reserve maintains a trade policy uncertainty index, which quantifies the degree of uncertainty surrounding U.S. trade policies. At present, this index is 12 standard deviations above its historical average. Additionally, overall economic policy uncertainty in the U.S. has reached its highest recorded level outside of the pandemic. This growing uncertainty has made the U.S. a less attractive destination for investors. Furthermore, it has also reduced the likelihood of additional interest rate hikes by the Federal Reserve. While Trump's tariffs and tax cuts are inherently inflationary, the Federal Reserve is less inclined to raise rates if the economy is already on the brink of recession. This is because interest rate hikes typically slow down economic activity, and raising rates during an economic downturn could exacerbate the situation. At the same time that market confidence in the U.S. is waning, optimism is growing regarding other major economies, particularly those of Europe and China. This optimism is further accelerating the dollar's decline. In Europe, for instance, Germany recently announced plans to abandon its constitutional debt brake, allowing it to allocate hundreds of billions of euros toward infrastructure and defense projects. Meanwhile, the European Union has declared that it will borrow an additional 150 billion euros at the EU level to finance further defense spending in response to Trump's decision to scale back U.S. support for Ukraine. While questions remain about the long-term sustainability of these debt-driven initiatives, in the short term, they are expected to stimulate economic growth. Investment banks, such as Goldman Sachs, have already revised their economic growth forecasts for both Germany and the broader Eurozone, with particularly significant upward adjustments for 2026 and 2027. Similarly, in China, the Chinese Communist Party recently unveiled a new stimulus package aimed at sustaining economic growth despite Trump's escalating tariffs. On Thursday morning, Chinese officials signaled a willingness to introduce additional stimulus measures if necessary to ensure that the economy remains on track to achieve its ambitious annual growth target of 5%. In summary, while market sentiment regarding the U.S. economy is turning increasingly negative, confidence in the economic outlook of major global players like Europe and China is rising. This divergence in economic expectations is contributing to the dollar's accelerating decline. As a final note, although the weakening dollar is largely a symptom of troubling economic conditions, most notably a looming recession in the world's largest economy, it does carry some potential benefits, at least from Trump's perspective. A weaker dollar makes American exports more competitive on the global market, which could help reduce the country's persistent trade deficit. Additionally, for the global economy, a weaker dollar can provide some relief, particularly for developing nations. Since commodities such as oil are often priced in U.S. dollars, a weaker dollar can make these essential goods more affordable. Moreover, it reduces the cost of servicing dollar-denominated debts, easing some of the financial pressures that have been weighing on developing economies in recent years. Ultimately, while the decline of the U.S. dollar signals significant economic uncertainty, its broader consequences will depend on how global markets and policymakers respond in the coming months.